Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. For the next 20 minutes, we'll talk about the rankings that CRISIL has assigned to various funds in various categories. Why is it that these rankings have been assigned? And of course, standard disclaimer that these rankings don't necessarily mean that these are the funds which are apt for you to buy, but they'll give you an idea about what is something that the fund is doing which is right, and is there something that the fund is doing wrong for which they have slipped in the rankings on the CRISIL parameters. Our guest today, Piyush Gupta, is Director of Fund Research at CRISIL and joins us on the show. Piyush, good having you. Thanks for joining in. Hope all is well.
Thanks, Neeraj, for having me. Good to back in the show. So all well at our end.
Great, awesome. So Piyush, we thought let's pick 5 categories on which we hear the most murmurs on our shows. And as a result of that, the ones that we would love to talk to you about today are the Flexi Cap category, the mid cap funds, the ELSS schemes. Might as well people start from the beginning of the year. The aggressive hybrid funds, because a lot of people are talking about that, and the corporate bond funds as well. So would love to talk to you about these 5 categories. And I'd like to start off with the Flexi Cap category, Piyush. And here, very surprisingly, I mean, one, your observations general about how the category is done, and then want to start off with the number 1 rank, which is IDBI Flexi Cap Fund. It just doesn't come into conversation at all in all through the last 12 months. And here it is sitting at the top of your pile.
Yeah, so Flexi Cap, of course, it's one of the largest category, in fact, the second largest category in the equity universe. If we were to start with the category as such, so while it is a Flexi Cap category, we don't see too much of variation among most of the funds in terms of market capitalization allocation, largely dominated by large cap when we look at last 3 years of portfolio. Now, coming to the fund, IDBI Flexi Cap Fund, it is, in fact, it is among the smallest fund in the category, close to about 400 crores. So fairly small fund. If you look at the performance, the fund has improved its performance in the latest quarter. Having said that, the fund was ranked 2 in the previous quarter as well. So which means that the fund was falling in the top 30 percentile in our universe that we were ranking even earlier. And even before the previous quarter, the fund was ranked 2 in the earlier quarters as well. So which means that the fund has been delivering returns, which is closer to top quartile or top 30 percentile in the last 3-4 years or so. When we rank the funds, while we look at the performance, we also look at portfolio based parameters. We look at how diversified the portfolio is, whether there is adequate liquidity in the underlying portfolio. These parameters are also looked at. For this particular fund, when we look at diversification at company level, it's a fairly diversified portfolio. Even at an industry level, while it is a small fund, its diversification is closer to the category average, which is unlike other smaller funds. Typically, you'll find a higher, I would say, diversification as well as a fairly good amount of liquidity given the smaller size of the fund. When we look at its performance, again, it's during the 1 year period and 9 months where the fund has actually given highest within the category. So which has obviously helped the performance of the fund. When we look at its portfolio over the 3-year period, it has seen some shift. Initially, it was dominated by, or rather, I would say, had relatively higher allocation to small and mid cap stocks. It's in the recent period where the fund has allocated larger allocation to large caps, which also meant that in the last quarter, where small and mid cap gave negative returns, large caps were fairly closer to the, or rather flat. It helped the fund in its performance in the recent quarter. There are some stocks which has worked for the fund, stocks which are part of pharmaceutical, IT, banking. Some of these sectors have actually helped the fund in generating higher return compared to the bench, compared to the category.
Okay, and on the flip side, and then I'll come to the rationale of these rankings and how should investors do. But let's first finish the category. UTI, which has been doing not so bad per se in probably the whole of FY20, whole of 2021,
Yes.
has slipped 2 places from number 1 to number 3. What happened here?
Yeah, so again, there is a decline in its performance in the recent quarter. In fact, it gave, when we look at the entire peer set, the fund had least returns within the category. It's only in the 3-year period, like you mentioned, the fund was doing well earlier, which meant that its 3-year performance is still higher than the benchmark or the category. It is in the recent period where the performance has slipped. Given its good performance in the earlier period, the fund also has fairly large AUM. It's close to 24,000 crore, which means that when we look at the liquidity in the underlying portfolio, it is relatively weaker compared to the category. Even when we look at diversification, the fund is, while it is fairly diversified at a company level, at a sector level, the fund has lesser number of sectors. For instance, its top 5 holding is about 63% compared to category average of 57%. The other, I think, factor that one needs to look at here is the fund had a higher exposure to mid-cap stocks. And it continued to have those exposures even in the latest quarter, which meant that when the performance turned for the mid-cap universe, the fund also got adversely impacted in its overall performance.
Okay. Now, just before we move on to the other categories, Piyush, how do you reckon viewers and investors can make use of this intelligence and the rankings that you bring to the table?
I think when we put out these rankings, the objective is to cover as many funds as possible. We also, when we look at the performance, when we look at the ranking, we just don't look at the performance. We look at the portfolio construction of the fund, which in a way plays out as you move ahead in terms of its performance. You ideally, the users should look at this ranking as a filter, one of the factor when they are deciding on their portfolio construction or when they are deciding on their shortlisting of funds. They need to look at their own, I would say, risk appetite. Within a category, there is a big divergence in terms of portfolio construction and hence the underlying risk in the portfolio. So while you look at the performance, look at the portfolio-based attributes also. And when we publish these rankings, the rankings are available for each of those parameters. So you know that if this particular fund is doing well while it's doing well in the performance, maybe its performance is relatively more volatile compared to the category. Or for that matter, the fund has a relatively higher diversification or a higher concentration depending on the fund that we're looking at. So all of these parameters are there and their rankings are available, which viewers can refer to.
Got it. Thanks for that. Now, let's move on to the next category, which is mid-cap funds. And here, not surprisingly, that one mid-cap fund has climbed atop the table. It was anyways doing well, but now is number 1 along with PGIM fund. And because I see quant funds doing well across a lot of categories, at least in terms of absolute returns. Now, can I ask you, why is it that quant has moved on to the number 1 position? Is it absolute returns or is it a mix of other factors too?
So quant again, like you mentioned, all of their funds, especially in the equity category, they have been doing well. Their assets under management, even though is still low, but I think when we look at their portfolio over the period of time, what we observe is that the fund typically has good amount of churn. And the portfolio that they construct is fairly concentrated. So on an average, you will find about 25 stocks in the portfolio compared to the category where you will have about 50 or 60 stocks. And when here we are looking at mid-cap, again, mid-cap here, they hold a fairly concentrated portfolio, which means that some of the stock selection that they do, if they work that, then it sort of translates into the performance. Second is there is a good amount of churn. When we looked at their portfolio over the last 3 years, there were about 190 odd stocks which entered and exited in the portfolio. So fairly good amount of churn, which means that the stocks are not held for a longer period of time. They are held for a shorter period of time and then exited as and when the returns are realized. This also means that the volatility in the performance is high, and in fact, it ranks 5 in our ranking when we look at the return volatility in this particular fund. Like I mentioned, the concentration is significantly high, which means that it ranks lower on industry and company concentration parameters. Given that it's a smaller size fund, liquidity parameter that we look at is where it ranks higher.
Okay. Okay. Interesting. And again, okay, so that's on quant, and a few reasons why that is now yours. Number one, compared to it being number two in the rankings that were given by CRISIL the last quarter or the last time. Now, one's fund, the UTI fund, which is again slipped, is in this category, which is UTI mid cap. And again, I think you enumerated some of the reasons when you talked about the Flexi cap fund category. Would the same reasons be applicable for the mid cap end as well?
Yeah, similar. So one, of course, in the equity category, I think performance is a key factor when it comes to ranking, and it drives the ranking. So to some extent, decline in its performance, especially in the last 1 year, has meant that the fund has slipped into the lower ranking, which is rank 3. Its 3-year performance is still higher than the category average, given the fact that the fund was doing well in the earlier period. The fund is, I would say, mid-size, so within the category, which means that it's in terms of liquidity, it is aligned to the category average. Concentration, fairly diversified portfolio, both at an industry as well as company level. Some of the stocks which didn't do well were forming part of sectors like consumer durable, banking, auto ancillary, which kind of led to its decline in the performance.
Okay. Well, so maybe tough times in general for a bunch of UTI funds which have the exposures to the mid cap, and as Piyush was talking about, and that's why even in the UTI mid cap fund has fallen in the rankings by a spot this time around, but it's fallen to number 3. We also keep that in mind. Now, ELSS, and the reason why Piyush frankly thought we should bring this, because it's always important to highlight with every show that if they want to save taxes, they shouldn't do it in the months of Jan, Feb, March for that year. Maybe they should start from the beginning. And we've done one show in April highlighting this. We are highlighting this in the month of May as well, that it's a good time as any to start your ELSS investments if you haven't already. And if you wanted to know what are the funds that you could look at, Piyush has already told us how you should use these rankings in conjunction with some other parameters and your study as well. But purely from a ranking perspective, one of the funds that holds its spot is the IDFC Tax Advantage Fund. It's not moved, and it stayed. In fact, all the three, Piyush, Quant, IDFC, and BOI AXA, have held on to their positions.
Yeah. So IDFC, again, is a fund which has been ranked 1, not just in the last 2 quarters, in fact, in the last 4 quarters, which means that the fund performance has been fairly consistent when we look at the last 4 years of returns. In terms of performance, the fund has delivered return higher than the category and also the benchmark across all the time frames. Now, when we look at its performance, and let's look at the portfolio first. So the portfolio has had relatively higher exposure to small cap stocks over the last 3-year period, which has sort of helped the fund in its performance. And given the fact that when you look at 3-year returns of small cap, it is highest among all the capitalization categories we have. In terms of portfolio attributes, the fund is fairly diversified both at a company as well as at the sector level. The liquidity in the portfolio is slightly weaker compared to the category. It's partly to do with the fact that the fund also has a relatively higher AUM, somewhere in the middle. The stocks which sort of helped its performance were in the sectors like software, auto, metals, and largely in the small and mid cap space, which kind of helped its maintaining the performance over the period of time.
Interesting. So they actually chose the right kind of mid caps as opposed to some other fund houses which may not have exposure to the right mid caps, as a result of which those lost their rankings, and as a result of which this fund has actually maintained its rankings.
Yeah, and the other fact is the fund has also maintained the small cap or mid cap allocation consistently for a period of time.
Okay.
So which also, and we look at a 3-year period, that's where you have a higher performance in the small cap category, which is kind of also helped the fund.
Okay. And then two fund houses which have lost their rankings on the tax saving fund side, both of which are usually believed to be adhering to the principles of buying high quality stocks. And both Mirae and Axis have slipped a position each, with the Mirae fund. Axis, of course, has slipped 2 positions, from number 3 to number 5. And Mirae has slipped 1 position. Now, why is it that these funds have gotten the lower rankings, Piyush?
So Mirae, I would say it's a slight decline in its performance. So we rank the fund on a scale of 1 to 5. If I would, and the fund has moved from 2 to 3.
2 to 3.
So it's a slight decline in its performance, which has sort of led this fund to slip from 2 to 3. If I were to look at the linear ranks, it's not a significant movement. It's just that there is a change in cluster for this particular fund. Having said that, this is a fund again which used to do well earlier. It used to be among the top ranked funds for a fairly long period of time, which meant that its 3-year performance is still good. It's only in the recent period where there is a decline in its performance. And over and above that, I think the fund typically has maintained higher allocation to large cap. So when you look at the portfolio over a 3-year period, the fund has maintained higher allocation to large cap compared to the category average. In the recent period, of course, it possibly would get benefited in the short term, like 3 months, where the large caps have started doing better compared to small and mid cap. It's only in the medium term period, where 1.5 year period, that's where the performance is slipped. Again, going back to the portfolio based attributes, given its larger size, the liquidity in the underlying portfolio is weaker. Volatility of the fund has also been higher. We looked at the portfolio churn ratio for this fund and compared it with the other funds in the category. We found that there is a relatively higher churn in this portfolio compared to the category, which meant that even the volatility in the performance has been higher for this fund compared to the category that we've seen.
Okay. Well, and in Axis, do you reckon that, just to follow up, in Axis, do you reckon that the performance got impacted in any fashion quite dramatically in Q4, or was it anyways dwindling lower and then took a bit of a nosedive? Because I think a lot of quality stocks did take a nosedive. I mean, I only ask this question because unfortunately for the fund house, it's involved in a set of news flow which isn't the most favorable.
Yeah, so Axis, again, it's a recent period where the decline in performance has led to its slippage. So it's moved from 3 to 5. When you look at the performance of this fund, 3 months and 6 months is where the fund had a least return on among the category. So minus 9% or for a 6-month period, which was lowest for the category. Which kind of resulted in decline in its performance. And again, if you look at this particular fund, historically also, they were maintaining relatively a smaller number of stocks in the portfolio, which meant that the diversification was lower compared to the category. Given its larger size, even the liquidity in the underlying portfolio is relatively weaker compared to the category. So it's a decline in the performance in the recent period, along with the concentration risk in the portfolio that the fund has been maintaining, has resulted in the decline in its ranking.
Got it. Okay. Thanks for that update. Now, move on from pure play equity funds to others. And I'm kind of trying to talk about aggressive hybrid as a category because a few advisors have spoken about that category. Piyush, can you talk a bit about whether aggressive hybrid funds are good enough to, as a category, to invest into currently, or would you believe that no, per se, there could be better categories also because of the dynamics? And then we'll talk about the two funds out there, which is the ICICI equity and debt fund, which is climbed 2 spots to the number one position in its category. And on the flip side, the PGIM fund, which is lost its ranking quite significantly from number 1 to number 4.
Yeah. So aggressive hybrid, given that you have a mix of equity and debt, I would feel that it's a category which is quite relevant for the investors, especially in the recent period when we have seen quite a bit of volatility in the equity market. This is a category which provides some bit of sort of balance to the overall portfolio. So from the category perspective, I think it's still a important category for investors to look at. Even in the past, we have seen that there are times when the performance of balance, as we used to call it earlier, some of the funds used to deliver returns on par even with the large cap funds. And that was primarily because there was a bit of stability that would come in during the downside when we see in the equity market. So to that extent, this category is still relevant. Yeah, sorry.
No, so then let's talk about the two funds. Now that you're saying that the category is relevant, one which has done really well and one which has done really shabbily on your performance parameters.
Yes, yes. So, just a broad overview of the category. So, while you have a balance between equity and debt, within equity, typically you will find a skewness towards large cap within the equity portfolio when you look at the overall category. Now, if you were to look at ICICI Prudential equity and debt fund, which has moved from 3 to 1, it's a fund which has fairly large assets under management within a category. This is also a fund which, if you were to go back maybe a quarter before earlier, the previous quarter, it was ranked 2 in our rankings earlier, which meant that it has been performing, it has been delivering stable returns over a period of time. In the recent period, it's largely driven by its performance in its portfolio over the 3-month, 6-month, and 9-month period, and its performance has been largely driven by stock selection, especially in the large cap category. This is a fund which has relatively higher exposure to large cap compared to the category when we look at the numbers. Plus, the fund has also recently taken exposure to within the debt portfolio into some of the securities which are rated lower than AAA, which has meant that one, performance for them from the large cap stocks. Second, relatively higher accrual from the sub AAA exposures has helped the fund in its performance. When we look at other portfolio-based attributes like diversification, credit quality, liquidity, the fund scores are relatively lower in the ranking. And that's also to do with the fact that the fund has fairly large assets under management. Given the fact that fund has taken exposure to some of the sub AAA exposures, the asset quality ranking or the ranking on the credit quality parameter is lower for the fund. Diversification is also weaker when we look at the company level exposure.
Okay. Well, interesting. And for the fund of that size to be doing that. So interesting thoughts out there. Any other aspects about PGIM fund which lead to such a sharp fall in the rankings for the fund?
Yeah, so PGIM, I think it's also a case of single exposure which kind of led to its decline in its performance. PGIM has exposure to one of the feeder fund, global feeder fund, which has led to its decline in performance. So We have seen globally the equity markets, quite a few large cap, large stocks in global market have seen a decline. And to that extent, that feeder funds witnessed a decline in NAV to the extent of almost 13% the last 1 quarter, and which kind of impacted its overall performance, the fund performance. As we look at the fund in its latest portfolio, what we have observed is the fund has further increased its exposure to that global feeder fund. So and that's primarily the reason for its decline in the ranking that we've done.
Okay. Well, if the global markets make a bit of a comeback, viewers never know. But yeah, maybe this very large exposure kind of is a bit of a red flag, and which is why it slipped from number 1 to number 4, if I'm not wrong, in the CRISIL rankings. Thanks for that, Piyush. Finally, corporate bond funds. And the opinion out here is fairly mixed. But if Nippon and Sundaram have done very well and climbed rankings, DSP corporate bond fund has slipped in rankings. Talk a bit about this.
So, corporate bond category, as we all know, it's a category which invests primarily into AAA and above securities, rated securities, sovereign or AAA, and which means that largely the performance is driven by the duration management in the portfolio. There is no limit as far as the SEBI definition is concerned in terms of duration of the underlying portfolio, unlike other categories, which means that active duration management primarily drives the performance of this category. At an overall level, we have seen that there is a steady reduction in the duration of the funds within the category, and it is in line with the hardening that we've seen, especially in the last 6 months in the debt market. So to that extent, the funds who are able to sort of manage the duration in the portfolio actively, they were able to generate superior returns compared to the other funds. When we look at Nippon Corporate Credit Fund, so there again, the fund had a lower modified duration compared to the category, which kind of helped its performance. If we look at the other parameters like asset quality, I would say it still has allocation which is relatively higher compared to the category as far as the sub AAA rated instruments are concerned. So to that extent, the asset quality of the fund is still weaker, which also translates into weaker liquidity of the fund. As far as the company level diversification is concerned, it's a fairly diversified portfolio. None of those exposures are exceeding the threshold that we look at a issuer level for the debt categories have exceeded. In the exposure to sectors, we look at exposures which are vulnerable in the current market condition and identify those sectors in the portfolio. Here we have seen that they had some exposure into sensitive sectors in the previous quarter, which of course they've reduced in the latest quarter. They had some exposure to wholesale finance in the previous quarter, which kind of had a lower impact or negative impact on its sector exposure to sensitive sector exposure parameter. Liquidity, again, it is relatively lower given that its asset quality is weaker compared to the category.
Got it. Okay. So if despite all of this, if it's kind of moved on to the number 1 position, then the positives outweigh the negatives, and the contra works for DSP corporate bond fund because that slipped in the rankings period.
Yeah, so DSP is a fund which follows a roll down strategy. So which means that they construct a portfolio at the beginning of the period. Typically, it's a three-year portfolio, and then allow that portfolio to mature over the 3-year period. Having said that, if there are any inflows, they purchase securities in a manner that those securities mature at the end of the 3 years. So, which also means that the ranking for this particular fund tends to be volatile. Like I mentioned earlier, for this particular category, duration management is what determines the performance of the fund most of the time, given the fact that there's very little which is there in the credit front. So this particular fund had their portfolio getting matured somewhere in the month of February and March, which meant that they constructed a portfolio, a fresh portfolio in the month of March with a duration close to 3 years, which adversely impacted its performance because we saw hardening in the yields in the latest quarter. Uh, the other factor which sort of adversely impacted its performance is because the portfolio was getting matured, they were running excessive cash, especially in the month of January and March, which kind of January and February, which impacted its performance in the ranking.
Okay. Okay. Well, this helps. This helps tremendously to know these rankings. Viewers, I presume that you might want to watch these rankings move over a period of time before you take a decision. But as Piyush said, that you can use these rankings in conjunction with the parameters to try and make a portfolio allocation decision into any of the categories or the funds. And Piyush, it was lovely having you today, taking your time and explaining in detail why each of the funds have moved the way they have and what are the categories entail at the current point of time. So thank you so much for that.
Thank you, Neeraj.
And the pleasure was ours. And viewers, thanks for tuning into this leg of the Mutual